Right now, something unusual is happening inside the global silver market, and most people haven't noticed it yet. Beneath the daily price charts and routine trading activity, a structural shift is quietly unfolding that could reshape how investors think about precious metals. The silver market may appear small compared to equities or bonds, but when you combine mining production, industrial demand, investment flows, and derivatives exposure, the broader ecosystem tied to silver easily approaches the scale of a trillion-dollar market structure. And suddenly, that structure is starting to move in ways traders did not expect. Futures markets are seeing unusual positioning changes. Physical inventories are shifting between major vault systems, and industrial demand continues to expand at a pace that many analysts believe the mining sector may struggle to match. What makes this moment particularly important is the speed of the change. In the span of just a few trading sessions, price volatility increased, trading volumes surged, and analysts began asking a question that rarely appears outside serious commodity discussions. Is the silver market approaching a structural supply imbalance? Silver occupies a unique position in the global economy because it functions both as a precious metal and as a critical industrial material. It sits inside electronics, solar panels, medical equipment, and advanced manufacturing. At the same time, investors treat it as a monetary hedge during periods of uncertainty. When both of those demand forces begin moving at the same time, the market can react very quickly. That's why experienced commodity analysts are watching the latest developments closely. What may look like routine market volatility on the surface could actually be the early signal of a much larger financial shift unfolding across the global metals market. At first glance, a sudden shift in the silver market might sound like a niche story relevant only to commodity traders or mining companies. But the reality is very different. Silver plays a critical role across multiple sectors of the global economy, meaning price disruptions can ripple far beyond the metals market itself. Modern electronics depend heavily on silver because of its unmatched electrical conductivity. Smartphones, computers, electric vehicles, and advanced medical devices all require silver components. Even more important is the role silver now plays in the global energy transition. Solar panels rely on silver-based conductive paste, making the metal a key ingredient in renewable energy infrastructure. As countries invest heavily in clean energy expansion, the demand for silver continues to grow. That means changes in silver pricing can influence manufacturing costs across entire industries. When the price of silver rises sharply, technology companies, solar manufacturers, and industrial producers all face increased input costs. On the financial side, silver also acts as a strategic investment asset. During periods of inflation, currency volatility, or geopolitical uncertainty, investors often move capital into precious metals as a hedge against financial instability. This dual role, industrial commodity and monetary metal, creates a powerful feedback loop. If industrial demand increases while investors simultaneously seek safe haven assets, silver can experience rapid price acceleration. For businesses, that translates into rising production costs and supply chain challenges. For investors, it can mean increased volatility in commodities markets and broader financial assets. And for governments trying to manage inflation and economic stability, precious metals often serve as a barometer of deeper financial stress. In other words, what happens in the silver market rarely stays confined to the silver market. It often reflects much larger economic forces unfolding beneath the surface. The current wave of attention around silver began with a sudden surge in trading activity across major futures exchanges. Within a short period of time, silver futures volumes spiked dramatically, indicating that large institutional participants were repositioning themselves in the market. Prices began pushing through short-term resistance levels that had previously held steady for weeks. As those levels broke, algorithmic trading systems automatically entered new positions, amplifying the move and increasing volatility. At the same time, analysts noticed an unusual pattern developing in warehouse inventory data connected to the futures market. These vaults hold physical silver that backs certain futures contracts. When inventory levels change significantly, either through withdrawals or transfers, it can signal tightening supply conditions or shifting delivery expectations. Reports showed meaningful movements of metal between registered and eligible vault categories, something that commodity analysts track very closely. Another factor driving the sudden market attention was the continued strength of industrial demand forecasts. Solar energy expansion, electronics manufacturing, and electric vehicle production are all increasing silver consumption. When traders began connecting these demand trends with the inventory movements and the surge in futures positioning, the market narrative shifted quickly. What initially looked like routine price volatility suddenly appeared to reflect deeper structural pressure building inside the silver supply chain. This combination of events, large futures market repositioning, shifting physical inventories, and strong industrial demand projections, created the trigger moment that caught many traders off guard. It was the kind of market development that often starts quietly, but has the potential to escalate into a much larger financial story if the underlying conditions continue to evolve. To understand what is really happening, it's necessary to examine the fundamental mechanics of the silver market. Unlike purely financial assets, silver must be physically mined, refined, transported, and delivered before it can enter the global supply chain. That process takes years of investment and development. Mining companies cannot simply increase production overnight when demand rises. Many silver mines are also secondary operations attached to other metals like copper, lead, or zinc. This means silver production often depends on the economics of entirely different commodities. On the demand side, however, growth can accelerate much more quickly. The expansion of solar energy infrastructure alone has dramatically increased silver consumption in recent years. Each solar panel requires small amounts of silver for conductive materials, but when production scales to millions of panels globally, the demand becomes enormous. At the same time, investors frequently increase precious metal exposure during periods of financial uncertainty. If those investment flows begin rising while industrial demand continues expanding, the supply-demand balance can tighten rapidly. Futures markets then react to these pressures because traders anticipate future shortages or price movements. As hedge funds and institutional investors reposition, futures contracts begin reflecting expectations rather than current physical supply. That can create powerful momentum in either direction. The core mechanism driving the current market tension is therefore a combination of slow-moving supply growth and rapidly evolving demand dynamics. When those forces collide, the result is often sudden volatility in prices, inventory movements, and institutional positioning. In other words, the silver market is not simply reacting to speculation. It is responding to structural forces that have been building quietly for years. When commodity markets experience sudden price swings, the consequences extend far beyond trading floors and financial charts. Real businesses and real workers feel the impact almost immediately. Manufacturers that rely heavily on silver as a production input must constantly manage cost exposure. Electronics companies, solar panel manufacturers, and industrial component producers often operate with tight margins. If silver prices spike rapidly, their raw material costs increase almost overnight. This forces difficult decisions. Companies may delay production, renegotiate supplier contracts, or pass higher costs on to consumers. In extreme cases, smaller manufacturers can be pushed out of the market entirely if they cannot absorb the increased costs. Mining companies face a different set of challenges. While higher prices may appear beneficial, mining operations require massive capital investments and long development timelines. If price volatility becomes too extreme, it can disrupt planning, financing, and expansion projects. Workers inside these industries are directly affected as well. Manufacturing slowdowns can lead to layoffs, reduced hours, or factory closures. Supply chain disruptions ripple through logistics companies, equipment suppliers, and regional economies that depend on industrial production. Even technology companies feel the pressure. As silver prices rise, the cost of producing electronics and renewable energy components increases. That can slow innovation cycles and raise prices for consumers around the world. Commodity volatility therefore becomes a human story as much as a financial one. What begins as a sudden market shift inside trading exchanges eventually spreads through factories, mining towns, and global supply chains. The effects may take months to fully appear, but history shows that sharp commodity disruptions rarely remain confined to financial markets alone. One of the factors intensifying the current situation is the growing pressure on global supply chains. Over the past several years, disruptions across logistics networks have exposed vulnerabilities in how raw materials move around the world. Shipping delays, energy price fluctuations, and geopolitical tensions have all affected the flow of industrial metals. Silver is no exception. The mining and refining process depends on stable transportation routes and reliable international trade networks. When those systems experience disruptions, the delivery of physical metal can slow down. This creates bottlenecks between mining production and industrial consumption. At the same time, global demand for advanced technology continues to accelerate. Semiconductor production, renewable energy infrastructure, and electric vehicle manufacturing all require complex supply chains that depend on critical materials like silver. When demand grows faster than supply logistics can accommodate, pressure builds within the market. Traders in the futures market begin pricing in potential shortages or delivery delays. This amplifies price volatility and increases uncertainty for industrial buyers. Another complication is the geographic concentration of certain mining operations. If political instability, regulatory changes, or labor disputes affect major producing regions, global supply can tighten quickly. These types of disruptions often develop gradually, before suddenly becoming visible in market data. As a result, supply chain instability acts as a compounding crisis, layered on top of existing demand pressures. Even if mining production remains steady, logistical disruptions can create the perception, or reality, of tightening supply. That perception alone can trigger defensive behavior from manufacturers and investors, pushing the market into a more volatile phase. Another force intensifying the silver market tension comes from the broader global monetary environment. Central banks around the world are navigating one of the most complex financial landscapes in decades. Inflation pressures remain persistent in many economies, while economic growth shows uneven signals across different regions. When inflation rises, investors often seek protection in tangible assets. Precious metals historically benefit from this type of financial environment because they cannot be printed or expanded like currency. Silver, in particular, attracts attention during inflation cycles because it is more volatile than gold and often responds more dramatically to shifts in investor sentiment. If institutional investors begin increasing precious metal allocations as a hedge against inflation or currency instability, additional demand enters the market from the financial side. This creates another layer of pressure on the supply-demand balance. Currency fluctuations also influence the silver market. Because commodities are typically priced in US dollars, movements in the dollar can significantly affect global metal prices. A weakening currency environment often pushes investors toward alternative stores of value. In this context, silver becomes part of a much larger macroeconomic narrative involving interest rates, inflation expectations, and global liquidity conditions. When these financial forces interact with the existing industrial demand for silver, the result can be a powerful compounding effect. The market begins reacting not only to physical supply factors, but also to investor psychology and macroeconomic risk perceptions. This combination of industrial demand and financial hedging demand makes silver one of the most complex commodities in the global financial system. The implications of a major shift in the silver market extend beyond individual companies or investors. Entire national economies can feel the effects when strategic commodities experience significant price movements. Countries that rely heavily on technology manufacturing, renewable energy expansion, or electronics production are particularly sensitive to changes in silver prices. Governments investing billions of dollars into clean energy infrastructure depend on stable access to materials used in solar technology. If silver prices rise dramatically or supply becomes constrained, the cost of national energy projects can increase substantially. At the same time, nations that produce silver as a mining resource may see economic benefits during price rallies. Higher commodity prices can generate increased export revenue, tax income, and investment in mining regions. However, even producing nations must balance these benefits with the risk of volatility, disrupting long-term economic planning. Strategic materials like silver often influence national trade balances and industrial competitiveness. If supply becomes uncertain or prices fluctuate rapidly, governments may begin reconsidering how they secure access to critical resources. Some countries may invest more heavily in domestic mining or recycling technologies to reduce dependence on imports. Others may adjust industrial policies to manage rising production costs. This is why analysts often describe precious metals markets as indicators of broader economic stress. When strategic commodities begin moving rapidly, they reveal deeper tensions inside the global economic system. Silver's importance to both industry and finance means its market behavior often signals changes that extend far beyond the metals sector itself. Looking ahead, the most important question is whether the recent developments represent temporary market volatility or the early stage of a deeper structural shift. Commodity markets often move in cycles, with periods of stability followed by sudden bursts of volatility. Silver has historically experienced dramatic price movements when supply constraints and investor demand align at the same time. What makes the current situation noteworthy is the combination of forces now interacting within the market. Industrial demand is rising due to technological expansion and renewable energy development. Supply growth remains relatively slow because mining projects take years to develop. At the same time, macroeconomic uncertainty continues influencing investor behavior in global financial markets. When these factors converge, they create conditions where small changes can produce outsized market reactions. Analysts are therefore watching inventory levels, futures positioning, and industrial demand indicators very closely. If supply pressures continue building while investment demand rises, silver could enter a more volatile phase similar to previous commodity cycles. However, markets rarely move in predictable straight lines. Prices can fluctuate dramatically before establishing a clear trend. For investors and businesses alike, the most important strategy is awareness. Understanding how physical supply, financial markets, and global economic forces interact provides a clearer picture of where the market may be heading. The recent shakeup in the silver market may ultimately prove to be a short-term event, but it could also be the early signal of a structural shift that reshapes how this critical metal trades in the years ahead.